Welcome back to the deep dive. Today, we're really plunging into quite a fascinating crossroads for the crypto market as we head into Q3 2025.
Yeah, it feels like a really pivotal moment.
We've got a stack of sources here, specifically focusing on a pretty detailed institutional analysis and strategic outlook. And our mission really is to unpack all of that, pull out the most important signals and insights just for you.
Right.
We want to help you understand where things stand, the potential trajectory, without getting totally bogged down in every single detail.
Let's do it.
Okay, let's unpack this. So this analysis, what's the immediate takeaway, the overall state?
Well, what jumps out immediately is just how pivotal this juncture feels. It's described as a mix of cautious optimism, definitely,
Okay.
but layered with some really high-stakes consolidation. Almost like a coiled spring, There's energy there, but the direction of that next immediate pop isn't quite certain.
And a lot of that tension seems centered on Bitcoin, doesn't it?
Okay.
Trading right up near its all-time high resistance.
Absolutely. And the sources are really clear. This latest surge, it wasn't just random market momentum.
Right.
It was heavily fueled by, well, unprecedented capital inflows into those newly approved U.S. spot ETFs.
That's the big story.
It really is. And it's not just a headline. It's fundamentally changing the demand floor for Bitcoin. It's a structural shift.
Institutional validation on that kind of scale is massive.
Huge tailwind. But here's the tension the sources really dig into. That strength in Bitcoin, it hasn't really translated across the board yet. The wider altcoin market is, well, it's lagging significantly, kind of waiting in the wings for a clear signal for capital to rotate.
Patiently or impatiently waiting, maybe.
Maybe impatiently. But the bigger picture, the macro environment, actually looks pretty supportive, according to these reports.
Okay, like what?
Well, you've got a structurally weakening U.S. dollar, the DXY hovering around 97.52. That's usually a tailwind for risk assets like crypto.
Right.
And global liquidity.
Right.
It's just enormous. We're talking a $170 trillion pool hitting record highs. That's serious fuel.
That is powerful fuel for risk assets.
It is. And the analysis really underlines this macro backdrop as sort of foundational to the longer-term bullish view. But,
Okay.
and this is important,
Okay.
if you look closer, the sources also flash some, let's say, amber warning lights for the near term.
Okay. So despite the good macro.
Exactly. Despite the favorable macro, when you look at the technicals and the derivatives indicators, they're suggesting things are getting a little bit overbought, and there's maybe excessive leverage building up, hints of froth.
So even with those strong structural tailwinds, the market might be technically set up for a bit of a stumble first, before the next leg up.
That seems to be the read, yeah. The probability of a corrective pullback before we see a really sustainable, strong advance into Q3, it looks pretty high, just to kind of reset things, flush out some of that leverage.
Right, a healthy correction, maybe?
Potentially. And layered on top of all this technical stuff are the narratives, the stories really driving the market right now.
Okay, what are those dominant themes the sources are tracking?
Well, the big one, obviously, is continued institutional adoption, largely powered by those ETFs. That's undeniable. But then you have the really exciting fusion of AI and blockchain, sometimes called DeFi.
Right, AI's everywhere.
It is. And then the tokenization of real-world assets, RWA, that's gaining serious traction, bridging TradFi and DeFi.
We hear a lot about RWA.
Huge potential there. And interestingly, the sources also note that the market seems to be factoring in a perceived shift towards maybe a more favorable political and regulatory climate in the U.S.
Yes, I saw that mentioned. The analysis neutrally points out the market view on a potential change in administration, specifically mentioning a potential Trump presidency.
Right.
But purely as one of these narratives influencing sentiment, not as a political prediction or endorsement itself.
Exactly. It's just about how traders and investors are positioning based on these potential shifts. And all this leads us to the fundamental tension right now, which the analysis frames really well.
Okay, what's that core tension?
So on one side, you have what the sources call the cold money. This is strong underlying on-chain accumulation, meaning we're seeing significant amounts of spot Bitcoin being withdrawn from exchanges. That's classic behavior from long-term holders, institutions maybe, buying it and putting it away securely.
Okay, the conviction buyers.
Exactly. But on the other side, you have the hot money. That's the over-leveraged speculative activity primarily in the derivatives markets, short-term bets.
Oh, so long-term conviction versus short-term speculation. That's the clash.
Precisely. And that creates this fragile short-term equilibrium. The long-term foundation with the accumulation and the macro support looks incredibly solid.
Right.
But the immediate price action is really susceptible to volatility whipped up by that short-term leverage. So how this tension resolves, who wins out in the immediate term, the accumulators or the leveraged players, that's absolutely key for the market's next big move.
Okay, let's zoom in on Bitcoin then, the market bellwether. Technically, what's the picture?
Well, Bitcoin is basically consolidating after that historic run. It's trading around, what, $107,484? Right near that big all-time high resistance around $112,000. The sources point to a bullish flag or maybe a pennant pattern forming on the weekly chart. Typically, that signals potential continuation upwards.
It needs that clean break. Right?
Oh, absolutely critical. It needs a decisive breakout above that, say, $110,400 to $112,000 resistance zone, preferably on good volume, to really confirm that bullish continuation. That's the level everyone's glued to.
And if it pulls back, what are the key support levels we need to watch?
Immediate support is probably around $105,000. But the really critical levels, the analysis flags, are the $100,300 recent retrace bottom, and then the zone around the $98,000 99-day EMA.
Okay.
A failure to hold that $98K to $100K area, that would be a pretty serious technical warning for this current market structure.
The sources also mentioned really high volume, over $22.5 billion in 24 hours. What does that tell us happening in this tight range?
Yeah, that kind of volume within a relatively tight trading band, roughly $104,500 to $107,300, it suggests compression.
Like the coiled spring you mentioned.
Exactly. A lot of positioning is happening, bulls and bears battling it out. It implies that a pretty volatile price expansion, either up or down, is likely coming soon out of this range.
Okay, looking at indicators, the daily RSI is up there, around 67.47. How do we read that?
Well, it's bullish. Momentum is clearly up, but it is getting close to that conventional overbought threshold around 70.
Right.
So that's one of those near-term cautionary signals we talked about. Suggests things might be a bit stretched, maybe needing a breather or a pullback to cool off. You'd watch for a bearish divergence, like price making a new high, but the RSI failing to as a warning sign.
But the MACD, that looks pretty strong still.
Yeah, the MACD is currently unambiguously bullish. It's got a positive histogram that's expanding, which confirms solid upward momentum is still in play.
Okay.
But again, a bearish crossover on the MACD would be a key trigger to watch for a potential shift in that momentum.
All right, now let's get to the really unique part of this cycle, the ETF effect and the on-chain evidence. The sources are crystal clear. Bitcoin is the leader, right? And its ATH surge wasn't really matched by the alts. Why is that significant?
Yeah, this is classic cycle behavior. It's typical of the early, maybe mid stages of a bull run.
Okay.
Big institutional money, the early retail wave. They tend to focus on the most liquid, most established asset first. That's Bitcoin.
And the scale this time is just different because of the ETFs.
Completely different. The analysis puts a number on it. Those U.S. spot BTC ETFs, they've sucked in a mind-bending $13.2 billion in net inflows just this year to date.
Wow. $13.2 billion.
Think about that. That's a fundamental demand shift that just didn't exist in previous cycles on this scale. It's huge.
Yep.
BlackRock's IBIT is dominating that flow too, grabbing like 81% plus of the daily volume.
And this fire hose of ETF money ties directly into what the on-chain data is showing.
Absolutely. It corroborates the story perfectly.
Yep.
The analysis highlights this stunning withdrawal figure, 65,800 Bitcoin.
65,800.
Valued at around $7.1 billion, withdrawn from exchanges in just 1 week.
Whoa.
That is a powerful textbook bullish signal of that cold money accumulation. It means serious, high-conviction players, likely institutions, maybe whales are buying spot and moving it off exchanges into long-term cold storage, taking supply offline.
So you have this flood of new institutional demand via ETFs like BlackRock's and Fidelity's.
Right, IBIT, FBTC leading the charge.
Oh.
But the sources also mention ongoing outflows from legacy products like Grayscale's GBTC. How does that balance out?
It's a really fascinating dynamic they point out. You've got this immense new demand coming in one door, but you also have steady selling pressure coming out another from GBTC. About $1.6 billion in outflows year to date from Grayscale.
So it's like a transfer.
Exactly. It's not just canceling out. It's a massive transfer of Bitcoin ownership from potentially earlier GBTC holders taking profits or switching to lower fee ETFs.
Right into the hands of this new wave of institutional owners buying through the spot ETFs. And the market's short-term stability really hangs on whether those powerful new ETF inflows keep coming strongly enough to absorb that GBTC selling and any other profit taking.
Okay, so if you combine those potentially overbought signals from indicators like the RSI with the high leverage we know is in the derivatives market, what picture does that paint for the near future?
It points pretty strongly towards vulnerability to a shakeout.
A shakeout, like a sharp drop.
Yeah, the analysis suggests a sharp corrective drop, maybe down towards that $100,000 to $105,000 range, is actually highly probable.
Okay, that sounds scary, but is it bearish long term?
Not necessarily, according to this view. It's framed more as a potentially necessary purge, clears out the excessive leverage, shakes out the weak hands, the hot money, and allows the market to build a healthier, more stable foundation for the next sustainable move higher. The cold money accumulators likely see dicks like that as buying opportunities.
Okay, let's zoom out then and look at the total market cap. The sources use this to show how capital is flowing. Total market cap, total, is around $3.3 trillion now.
Yeah, looking at the total chart, it confirms the big picture is still bullish. The macro trend is intact, trading within a pretty clear ascending channel.
Wow.
But it is getting close to the upper boundary, the resistance line of that channel.
Okay.
Which suggests the market as a whole might be due for a bit of a consolidation phase, maybe a pullback within the channel. A move towards the middle, say the $2.5 trillion median line, would actually be pretty healthy for the overall structure long term.
Right, now let's isolate the altcoins. TOTAL2, which includes Ethereum, sitting at $1.18 trillion.
Okay, this chart is at a really, really critical inflection point. It's pushing right up against its major resistance level from the peak of the 2021 bull cycle.
The old highs.
Exactly, and the analysis highlights this specifically. The fact that TOTAL2 hasn't managed to break through this level yet, even while Bitcoin was hitting new all-time highs. That's the clearest technical evidence you could ask for, showing that altcoins are currently lagging Bitcoin.
So a breakout here is the key signal.
A decisive breakout above that 2021 peak resistance on TOTAL2. That's the key technical signal many are waiting for. It would likely signal the start of a broad, sustained altcoin rally.
And if we look even further down the risk curve at pure altcoins, excluding BTC and ETH like TOTAL3, shows even more weakness.
Yeah, absolutely. Charts like TOTAL3, which is around $648 billion, and the broader others category, they are significantly below their 2021 peaks.
Right.
Stuck in prolonged consolidation. It just confirms that broad risk-on appetite hasn't really cascaded down into the most speculative corners of the market yet.
So this staged performance, Bitcoin leads, then Total approaches its channel top, then TOTAL2 hits that key 2021 resistance, and Total others are still way behind. This fits the classic crypto cycle theory perfectly.
It's a textbook example, according to this analysis. Capital flows in predictable phases, typically.
Hi, Sue.
It secures a position in the safest asset first, Bitcoin. Then, once Bitcoin makes its big move or starts consolidating, capital starts rotating down the risk curve into the large cap alts, like Ether, which drives TOTAL2.
Okay.
And then finally, if the risk appetite is really strong, it flows into the smaller, more speculative altcoins, driving TOTAL3 and the others.
So the current lag in TOTAL2 and TOTAL3 isn't necessarily bearish for their future potential.
Exactly. It's framed as a leading indicator. It suggests that the most explosive phase for altcoins, the part where they see the biggest percentage gains, is likely still to come. It happens after Bitcoin has done its initial heavy lifting and consolidated those gains.
And this potential altcoin run we're talking about, it's heavily dependent on that macro picture, specifically global liquidity.
Critically dependent. The analysis draws a really strong correlation between altcoin performance, especially TOTAL2, and global money supply metrics like M2.
Right.
Expanding global liquidity is basically the rocket fuel for risk-on behavior in altcoins.
So a question for you listening then is, how closely are you tracking those global liquidity indicators?
Because the analysis suggests they are probably the primary macro driver for the altcoin market right now. Any unexpected U-turn towards hawkish central bank policy or a sudden contraction in global liquidity, that would pose a direct threat to this potential altcoin rally scenario.
Okay, speaking of critical charts for altcoin investors, let's talk Bitcoin dominance. BTC.D, currently around 64.48%. The sources call this arguably the most important chart for predicting the next major market move.
Yeah, that's a bold claim, but you can see why they say it, given where it is right now. BTC-D is at its most critical technical point in over 2 years.
Also,
It's pressing right up against this really formidable resistance ceiling, that 64% to 65% area. It's tried to break higher multiple times and failed.
and what does the technical pattern look like on the dominance chart itself?
Well, on the weekly chart, it's forming a large rising wedge pattern.
Okay, and what does that usually mean?
Classically, a rising wedge is interpreted as a bearish reversal pattern, meaning it's more likely to break downwards than upwards.
Oh, okay.
So the key signal everyone's watching for is a confirmed breakdown from the lower trend line support of this wedge, if that happens decisively.
Yeah.
The analysis suggests it would signal a significant, sustained rotation of capital out of Bitcoin and into altcoins, the start of a real alt season.
So, sentiment on this chart must be totally polarized right now.
Oh, completely. You've got one camp looking at the trend, expecting a breakout above 65%, maybe heading way higher, 68%, 70%, even 80% plus dominance.
Which would be bad for alts versus Bitcoin.
Terrible for altcoin performance relative to Bitcoin. A flight to safety, essentially. Then you have the other camp looking at that rising wedge, the repeated failures at resistance. They see a textbook topping formation and are forecasting an imminent free fall in dominance, which would be the trigger that ignites that explosive alt season.
And this links directly back to the historical cycle patterns we've seen before.
It's the defining characteristic, really. Bitcoin leads the charge out of the bear market. Its dominance rises as capital floods in.
Right.
Then, as Bitcoin peaks or enters a consolidation phase, profits and new capital start rotating down the risk curve into alts. That's when dominance falls sharply.
Like in 2017 and 2021.
Exactly. Those major alt seasons were preceded by BTC-D peaking and then declining significantly. So the analysis points to a decisive weekly close below the wedge support, and specifically below the 60% level, as the key trigger for a confirmed structural shift towards altcoin outperformance this time around.
So for someone who's heavily focused on altcoins, this BTC-D chart is maybe even more important than the actual Bitcoin price chart.
If your goal is altcoin outperformance, meaning you want your alts to gain more percentage-wise than Bitcoin, then yes, tracking BTC-D is arguably more critical.
Right, because that's what defines an alt season.
Exactly. Outperformance happens when BTC-D is falling. So the strategic implication presented here is, maybe maintain a higher allocation to Bitcoin while dominance is climbing or chopping around your resistance. But be ready, have a plan to rotate more heavily into a diversified basket of altcoins if and when BTC-D confirms that structural breakdown below those key levels, like 60%.
That provides a really clear strategic framework. Okay, let's shift focus to the altcoin landscape itself. The sources really hammer home this idea that in 2025, it's all about the narratives.
Yeah, this is a crucial insight from the analysis, I think. The market dynamic has shifted. It's less about, the generic layer 1 blockchain tech specs and much more about these powerful thematic narratives that are capturing attention, attracting capital, attracting talent. The market seems to move in these thematic baskets now.
Interesting. So what are the key narratives and sectors the sources are highlighting right now?
Okay. Top of the list, maybe unsurprisingly, is AI. The whole fusion of artificial intelligence and blockchain, sometimes called DeFi.
Right. Projects like Fetch.ai, BitandSoar.
Exactly. FET-TAO, also the Graph, GRP. They've seen really strong performance, driven by all the excitement around AI generally, plus the specific need for decentralized compute and data solutions.
Okay, what else?
RWA, real-world asset tokenization. This is about taking traditional assets, things like bonds, private credit, real estate, even intellectual property, and bringing them onto the blockchain as tokens.
The TradFi bridge.
Precisely.
Cool.
It's framed as this massive multi-trillion-dollar opportunity, and it's getting serious validation from big TradFi players like BlackRock getting involved.
Projects there.
Projects like Ondo, ONDO, Maple, CyroUP are mentioned as key players, also showing strong performance recently. Key catalysts there are further institutional adoption and maybe regulatory clarity.
Any other hot sectors?
Yeah, DePIN, decentralized physical infrastructure networks. This is a fascinating one. Using token incentives to get people to build and operate real-world infrastructure.
Like what kind of infrastructure?
Things like decentralized wireless networks like Helium Mobile, data storage, energy grids, even geospatial networks like GeoNet, GEOD. The potential growth projections here are huge, like 100 by 1000x, but it's still emerging. Needs real-world partnerships and network effects to take off.
Okay. What about DeFi? Is that still a narrative?
Yes, but it's evolving. Call it DeFi 2.0 with a real focus now on capital efficiency and new yield generation mechanisms. Think liquid staking and especially restaking.
Eigenlayer and all that.
Exactly. Projects like Athena, ENA with its synthetic dollar, Pendle for yield trading, Lido DAO, LDO, still dominant in liquid staking. Performance has been strong here, driven by these new services built on Eigenlayer and the adoption of liquid restaking tokens, LRTs.
And the more established alt narratives, like gaming.
Web3 gaming is still a major narrative. Focuses on player ownership through NFTs, token economies within games. Names like Immutable, IMX, Gala, GALA are prominent.
How's that performing?
Performance has been more neutral or mixed lately, according to the analysis. It feels like it's still waiting for those truly breakthrough AAA quality games and maybe more seamless wallet experiences for mass adoption.
You can't have a crypto discussion without
Memecoins, yep. High beta speculation, purely community and narrative driven. Think Dogecoin, DOGE, Shiba Inu, SHIB, Pepe, PEP.
proxy for retail sentiment.
Exactly. A good proxy for retail risk appetite and overall market liquidity. Performance can be explosive, but obviously very volatile, driven entirely by viral trends and social media momentum.
And the analysis mentioned that even institutions are looking beyond just Bitcoin and Ether now into these narratives.
Yeah, that's a really key validation point. The trend isn't just institutions buying BTC and maybe ETH anymore. They're increasingly looking at a core satellite approach.
Meaning
Meaning a core holding of BTC, but then a smaller satellite allocation that's diversified across these promising thematic altcoin narratives, AI, RWA, DePIN, etc.
And seeing specific projects mentioned in institutional research validates this.
Right. When you see firms like Grayscale, including projects like Maple and RWA or Story Protocol, maybe IPRWA overlap in their research reports, it shows these themes are being taken seriously at an institutional level. They're not just retail fads.
So the really crucial strategic insight here, the big takeaway on alts, is this narrative-first approach.
Absolutely. The sources really emphasize this. In this phase of the market, the story, the narrative is often more important for price performance than the underlying technology itself.
Really. More important than the tech.
It sounds counterintuitive, but the market seems to flow in these thematic baskets. If the AI narrative is hot, a rising tide lifts most AI-related tokens, sometimes irrespective of their individual tech merits or progress. Project success becomes strongly linked to aligning with and capturing a dominant, compelling narrative.
So your analysis process needs to change.
It has to. It needs to be narrative first. Identify the powerful themes that have momentum and capital flowing towards them, then drill down to find the best projects within those themes. A technically brilliant project stuck in a weak or dying narrative is likely going to underperform one that's maybe less advanced but riding a hot narrative wave.
That's a really important point.
Yeah.
Okay, let's dig into the market mechanics derivatives versus on-chain data. The sources call this the battle between hot money and cold money. Explain that.
Yeah, this distinction is fundamental to understanding the market's current fragility, you could say. Derivatives represent the hot money.
Okay.
It's leveraged, it's speculative, it's focused on short-term price movements. We see positive funding rates for both Bitcoin, plus 0.00072%, and Ethereum, plus more 0.0106%.
Meaning longs are paying shorts.
Exactly. It shows the dominant position is long, indicating generally bullish sentiment, although the rates aren't super high, so maybe not euphoric territory yet.
And open interest.
Open interest is high, $34.3 billion for BTC, $16.5 billion for ETH, and it's been rising along with price. That confirms new capital is flowing into these leveraged long positions.
But that's also risk.
It's huge risk. It represents a large pool of capital that's vulnerable to liquidation if the price moves sharply against them. This is the volatile, short-term side of the market equation.
And the on-chain data represents the cold money.
Precisely. On-chain data reflects the cold money, the high-conviction long-term holders, those massive net outflows of Bitcoin and Ethereum from exchanges we talked about earlier.
Yeah, the 65,800 BTC in a week.
That's a powerful multi-billion-dollar signal of accumulation. Assets moving off exchanges, likely into cold storage wallets, means they're intended for long-term holding. It's spot buying by smart money. By institutions, perhaps.
Any other on-chain signals?
Yeah, the expanding supply of stablecoins is another key one, often called dry powder.
Money on the sidelines.
Exactly. It signals significant capital is sitting ready, potentially waiting to buy dips or fuel the next leg up. This is the long-term, high-conviction side of the market.
So you have these two very different forces clashing. creating that fragility you mentioned.
That's the core bifurcation, the split personality of the market right now. You've got the leveraged hot money in derivatives creating potential for sharp short-term volatility and price swings. But underneath, you have the accumulating cold money revealed by the on-chain data, providing strong underlying support and reflecting long-term conviction.
Which explains why that shakeout correction is seen as likely.
Exactly. A liquidation cascade, that sharp, maybe brief correction, is considered probable and maybe even healthy in the view of this analysis. It purges the excess short-term leverage, the hot money.
While the cold money sees it as
Potentially a buying opportunity. It resets the market for a healthier move. So you should probably expect short-term volatility to be a feature, not a bug, as the market works through this dynamic.
Okay, finally, let's wrap this all into the macroeconomic context. The source is called Global Liquidity, the global liquidity engine for crypto. That sounds important.
It's described as potentially the single most critical macro factor. Some estimates suggest it could influence as much as 90% of Bitcoin's major price movements.
Wow.
90%.
It's a huge claim, but it highlights the sensitivity. Key indicators supporting the crypto market now include that weakening U.S. dollar we mentioned, DSY around 97.52, makes dollar-priced assets like Bitcoin cheaper for foreign buyers.
And interest rates.
Stabilized U.S. 10-year Treasury yields hovering around 4.4%. When yields aren't screaming higher, it reduces the opportunity cost of holding non-yielding assets like Bitcoin compared to bonds.
But there's also that strong correlation with tech stocks, isn't there? That's a risk.
Yes, a very significant correlation, particularly with the Nasdaq index. Tech stocks are near their all-time highs too, but some momentum indicators are showing signs of weakening.
So if tech rolls over, a significant downturn in the broader tech market would almost certainly act as a headwind for crypto, given how tightly correlated they've been. That's a key risk to watch.
But let's circle back to that massive $170 trillion global liquidity pool. Is that the primary driver overriding even tech correlation sometimes?
According to this analysis, yes, it's the dominant force over the medium to long term. That pool is at record highs and, crucially, still expanding overall.
Even with the Fed doing QT.
Yeah, it's interesting. While central banks like the Fed might technically be tightening through quantitative tightening, other global liquidity sources are apparently more than offsetting it. Things like the expansion of the global collateral pool, massive government debt issuance.
Okay.
These factors are keeping the overall liquidity tide rising. And the projection outlined in the sources is that this trend remains positive through 2025, maybe peaking sometime in mid-2026.
And Bitcoin and crypto more broadly essentially act as a high beta play on that global liquidity.
Exactly. Think of Bitcoin as a leverage bet on the expansion of global liquidity. When liquidity is abundant and sloshing around the system, it tends to flow into riskier assets offering higher potential returns, like crypto.
And when it contracts?
When liquidity tightens, risk assets like crypto tend to get hit first and hardest. So, your long-term macro view on crypto, according to this perspective, is fundamentally tied to your view on the future path of global liquidity.
So if you believe, structurally, that global incentives favor continued monetary expansion, deficits, etc.,
then that forms the basis for a long-term bullish stance on crypto, seeing it as a way to essentially get leveraged exposure to that ongoing liquidity expansion trend.
Okay, so pulling this all together,
Yeah.
What's the strategic outlook presented in these sources? Let's break it down. Short-term versus medium-term.
Right, short-term first. Looking out, say, the next 7 to 14 days. The outlook is described as neutral, but with a clear bearish tilt.
Bearish tilt. Wow.
Because Bitcoin is right up against that major ATH resistance. Indicators like the RSI are looking a bit extended, overbought territory nearby. And crucially, there's that evidence of excess speculation and leverage in the derivatives market we discussed.
Okay, so a pullback is probable.
Highly probable is the assessment. The likely scenario painted is a rejection from that 112K resistance zone, leading to a correction back towards 105K, maybe even dipping into the $102K support area.
That's the shakeout.
That's the potential shakeout to clear the decks, reset the leverage. And if Bitcoin drops like that, you'd expect altcoins to see even larger percentage declines.
What are the bearish triggers to watch for?
Key things would be Bitcoin failing to break 112K, especially on high volume selling. A confirmed bearish MACD crossover on higher time frames, like the daily or weekly, or a significant sustained increase in Bitcoin flowing back onto exchanges, suggesting profit-taking or distribution.
Okay, that's the short-term cautious view. What about the medium-term outlook heading into and through Q3 2025?
that picture shifts to cautiously bullish. The analysis expects those strong structural tailwinds we identified.
ETF demand, liquidity, weak dollar.
Exactly. Those are expected to ultimately outweigh the short-term corrective pressures.
So the probable scenario medium term
Is that after this likely correction finds support, hopefully above that critical $100 K level, Bitcoin then gathers strength for a definitive, powerful breakout above the 112K all-time high resistance.
and then targets higher.
Post-breakout targets mentioned are in the 135K to $150 K range initially, and this period of Bitcoin strength, consolidating at new highs, is then expected to trigger the key event for altcoins.
The dominance breakdown.
The Bitcoin dominance breakdown, finally breaking down decisively from that 65% resistance ceiling.
And that kicks off the alt season proper.
That's the sequence anticipated. A confirmed breakdown below 60% dominance would signal the capital rotation is really happening, leading to a strong, though likely selective, alt season.
Selective meaning led by those strong narratives.
Precisely. Led by themes like AI, RWA, DePIN that have institutional interest and clear catalysts. Bullish triggers for this whole medium-term scenario would be a decisive weekly close for Bitcoin above 112K, BTC-D confirming its breakdown below 60%, or that TOTAL2 chart finally breaking convincingly above its 2021 all-time high.
What are the biggest risks? What could blow up this cautiously bullish medium-term thesis?
The sources flag a few critical ones. A major unexpected macro shock, maybe inflation comes roaring back unexpectedly, forcing central banks to slam on the brakes and turn sharply hawkish again.
Okay.
Geopolitical escalation. A significant widening of global conflicts could cause a broad flight to safety, away from risk assets like crypto and into cash or gold.
Regulatory risk.
Always a factor. A significant regulatory surprise, like an unexpected harsh crackdown on major crypto exchange, stablecoin issuer, or DeFi protocol could spook the market badly.
And the ETFs themselves.
Yeah, ETF inflow exhaustion. This is crucial. If those vital net inflows into the spot Bitcoin ETFs suddenly dry up or even reverse significantly before that legacy selling pressure from GBTC has fully played out, that could remove a key pillar of support for the market.
Okay, so summing it all up, the picture painted by these sources is really one of a market with incredibly strong structural foundations.
Right, that long-term accumulation, the macro liquidity tailwinds.
But at the same time, it's quite vulnerable in the immediate short term to a volatility event, a shakeout, driven by that leveraged speculation bumping up against major resistance.
That tension between the short-term fragility and the long-term strength is really the core takeaway, I think.
So thinking about that, and especially considering the shift towards a narrative-first approach in the altcoin world, and that fascinating tug-of-war between the hot money and derivatives and the patient cold money accumulating on-chain. How might you, listening right now, approach navigating the potential volatility that seems likely ahead? How do you plan to distinguish between what might just be short-term market noise and that powerful underlying long-term trend being fueled by global liquidity and institutional adoption? What stands out most significantly to you from this deep dive today?